Welcome back to the Williams Real Estate channel. Today we're discussing why I have personally sold out of all my equities. Do you like my new hat for all the haters? So yes, that's right. I've sold out of all my equities, shares sold, and got out of all equities invested in my super. And before we run through it all, just a disclaimer. I know you folks like it rough and raw, so I thought I'd do it a bit of a freestyle video today. So before we get into it all, just a disclaimer, because I'm not a financial advisor or planner. I'm a property investor, although it's on my list to get a financial planning license so I can speak more freely. But yes, I'm not a financial planner or advisor. This is general content in nature and is not personal nor general advice. Prior to making any investment decision, be sure to seek independent financial, legal, tax advice. So, with all that said, this is my story. This is what I'm doing. Take it with a grain of salt. I'm forever thankful that I came across Phil J. Anderson, Akil Patel, Fred Harrison, Kathy. There's a few handful of them that speak to it. But anyway, the 18-year land cycle is our framework I use not only to invest in property, but I invest across all markets. Shares, I had my super geared into the equities markets. And I use this framework to guide myself, to invest, and to show clients why we're buying in certain markets like Sydney, Melbourne, and plucking off the low-hanging fruit in regional VIC and New South Wales at this stage of the cycle and not getting caught up with all the FOMO, stupid money that's going into Brisbane, Perth, Adelaide, Darwin, and their respective regions. Because we are on this blue marker coming in now to equivalent point of the cycle of January 2007, early 2007. So from that, you can peel back the layers and look at every asset class. If it's property, if it's different types of property, individual units, villas, townhouses, blocks of apartments, commercial property, houses in the regions, blocks of apartments in the regions, metro region, everywhere, everywhere goes through growth cycles, everywhere goes through downturns, everywhere goes through long, stagnant, flat periods. So its timing is key. 90% of the heavy lifting will be done by the underlying market cycle, and it'll fucking wipe a lot of people out also coming into the next downturn because every second one is a big one. Being Australia sailed through the GFC. We didn't sail through the 1991 recession we had to have. Ask any baby boomer that was holding property at the time, interest rates got to 17 odd percent, it hurt. We're about to go through that. Similar big land driven downturn. Every second one is a big one. So, with that said, this is why we use the framework so we can allocate funds. This is what I do. I allocate funds throughout the cycle. And as an investor, you're moving money around. If it's you're moving money from one state to the next state, either buying or selling or putting it into equities or getting out of equities. And for the purpose of this video was I'm the fuck out of equities because we're now in a similar point of the cycle of early 2007. And before we get into it all, I came across this 18-year land cycle back in 2010, 11, 12, when I was just getting out of school. I finished school in 2011. And before the GFC hit, my father had an oil distribution business. They printed money in the 70s, 80s, 90s, 2000s, all the way up to 2007. Come 2008, 9, 10, the business went broke. I could never work out how the hell can a business go so well for so long and then out of left field, it went broke. Along with that, everyone lost half their super. Equities globally went back 50%. that's how I came across this. I was flabbergasted that no one could see it coming. I was like, surely someone can see this fucking shit coming, right? So that's when I came across Phil Anderson, Brett Harrison, read all their books, Akil Patel, subscribed to their work, looked them up, property share market economics, get on their subscription, read all their books, and follow me. This is what I use this framework now to give myself clarity, firstly, to invest personally, and then also helping others do the same. A lot of people ask me why I sound so different to most other buyers agents out there. Yes, I am a buyer's agent. I help people buy investment properties, but I don't consider myself a buyer's agent. I'm a professional investor, not just property, but property and the stock markets. And the purpose of this video is to explain why I'm fully out of equities. And this is the reason why. So we're coming now into a similar point of the cycle of early 2007. If we look back at history, let's have a look at what happened to the stock markets around the world. So first of all, we'll bring up ASX 200, the top 200 companies in Australia listed on the Australian stock market. Is where about 30%, 30% of everyone's super is invested into. 70% of everyone's super, if you just leave it up to the super funds, they invest it offshore to the likes of the US and the UK markets in their stock markets. You're pretty much buying this. So as you can see, in September, October 2007, the Australian share market hit 6,700 points. The GFC hit and she sacked the shit, went down to 3,300 odd, lost 50%, and then took a good decade to recover to its previous high in 2019. So over a decade, 12 years. So I came across this. I had my super just geared into age bracket, and then I looked into the 18-year land cycle, and I got out of the Australian share market in late 2019 because we were due for the mid-cycle slowdown, which we now know was the COVID recession. Something will get labeled being the mid-cycle or the end of cycle downturn, but we were due come late 2019. If you follow all the work that property share market economics does, you can also follow myself to give you a broader macro view of the world. We were due for something, and COVID came along. COVID got the blame. The one before that was the dot-com bust. So I got out fully geared into cash in late 2019, and I avoided the correction to the market. It got to 7,000 points in January 2020, and then again sacked the shit to 5,000. Typically during the mid cycles, the stock markets get hit about 30 to 40%, not as severe as the end of cycle. But I avoided that. I moved it all into cash, went onto my super fund, hit the button for cash. 2 days later, it was all in cash. Avoided losing 30, 40%. And then in 2020, late 2020, 21, I started gearing it all back in. So I didn't whack it all back in at once. So I put 25%, 25%, 25% until I was fully in as of 2020, 21. And then I rode it all the way. Recently, I've asked the accountant to hit the switch, and we're rolling it all into cash now and reallocating the funds, which we'll get to in the future slides. And I managed to, obviously I contributed to my super, but also in the later stages of the 18-year land cycle, in the second half, that's when property construction kicks into gear, where we see globally a big draw on Australian commodities, our iron ore, coal seam gas, which goes into these massive projects globally. So that sets off our mining sector, sets off the ASX. So bank shares, miners, property companies outperform in the later stage of the cycle, in the second half, which is predominantly what the ASX is. So I elected, as of 2020 and onwards, to be 100% ASX shares. Put it all in. And I rode it all the way up since. We avoided the downturn and capitalized on the upturn, which we now have been able to scrape together, combine myself and Alex, about 250 grand in equity, which we're now using for a deposit down payment for a block of flats, which I'll explain in a little bit, because I would rather get out now, which is what I've done, than right at the point of the cycle. Like, we're coming now into early 2007. We're sure there's going to be maybe another year or so worth of growth. Who knows? No one has a crystal ball, but this is the framework you can use as a guide. At some point, something will happen in the market globally. It might be Putin going after Poland. It might be China going for Taiwan. Trump might decide to go for Greenland. Something will panic the market, which will prick the bubble, and then everyone will be selling. The end of cycle, land-driven downturn, stock markets historically take up to 60 to 70% downturn, on average 50. It's a bigger one, and can take up to 10 to 12 years to recover. So I didn't want to lose 250 grand worth of equity, see that go down to 120 and then take 10 years or so to recover to the same price point. I've reallocated those funds. I've elected to move it all into cash. We're rolling it into a deposit to buy a block of units to ride the next wave. Not saying that I'm never going to come back to equities. I will, but when there's blood on the streets in probably 5-6 years' time. If you look at what Warren Buffett's doing, he's been cashing up since 2024. He can see the writing on the wall. He's sold half of his Apple share. He's got like 360 billion worth of cash. He'll come back into the market in the coming years and ride the next wave. So as an investor, you need to be contrarian. You need to be opposite to what the mainstream herd are doing. You have to be cautious or fearful when others are greedy, and you need to be aggressive when others are fearful. It's counter-cyclical to what the market is doing. So now everyone's optimistic. We've seen a good bull run recent years. It's not just the ASX. We've seen this in the Dow Jones. So we're now hitting all-time high Dow Jones. So for everyone's super that they're just leaving it up to the super funds to manage, they'll have 70% of equity invested into this, which is hitting all-time high. And if we look back at similar point of history, 2007, come to that October 2007, topped out nearly 14,000 points and went down to 7,000, lost 50%, and then took a good. So if you hold in any asset class, eventually you'll come back into the green. If you hold anything long enough, you'll make money. But I'm looking to outperform the market and to preserve capital and put that capital to better use over the next 3 to 5 years. We will come back. I will come back and invest into stock markets and individual stocks and the indexes as well. But in my opinion, from what I'm doing today, it's not the best investment for the next 5 to 10 years. So the last 10 years of equities has gone pretty well. 10, 15 years, solid bull run. But over the next 5 to 10 years, it probably won't look like that. I see the Dow Jones probably hitting over 50,000 points, maybe 60,000, then coming back to probably 25, 30,000 points, and then taking a good 5 to 10 years to recover. So same goes for the S&P 500. It's even starting to show signs of rolling over at nearly 7,000 points. If we look back at history, similar points of the cycle, we're now in early 2007, equivalent point, where it still had a little bit more growth up to September, October 2007, 1,400. nearly 1,500, then went down to 700 odd points. Again, lost 50%. This is the FTSE 100, UK stock market, also hitting all-time high. If you look back at similar points of history, early 2007, there was a couple more solid months, and then come September, October, topped out around 6,700 points and went down to 3,800. Good 40%. And then took from 2007 to 14, again, another 7 to 8 years to recover to the same price point. So what have we done? We've moved into cash and we bought this, a block of 4 2-bedroom apartments. Asking price was over $1 million. I managed to buy it for 930,000. Great deal. The replacement value of this to buy a block of land, 500-600. It cost minimum 600-700 to build. If you were to replace this, 2.5-3 million minimum. We got it for 930,000. So buy property for at least half, if not a third, of its intrinsic value with strong yields. There's 4 2-beds. They're currently renting for on average $330 a week. But in Kempsey, there's fucking nothing for available. So I can push rents to easy for 400 each without even having to do much work to them. That's just the market. But currently 330 times 4 times 52. It's bringing in 68 grand a year divided by 930,000 times 100. So 7.3% yield on day one, and literally going to renew leases to 400. Say, here's a renewed lease, 12 months, 400. That's the option one. Option two, get out. And if they vacate, then I'll clean them up, rip out carpet. These ones just need carpet and kitchens. So 400 times 4 times 52. So you could easily push it to 83 grand a year divided by 930 times 100, nearly 9% return. So cracking deal. These are out there. They come up. They're sporadic though. They're not always in this town. This was Kempsey in the mid-north coast of New South Wales. They are sporadic. They are here, there, anywhere. We are still guided though using the 18-year land cycle. So we're not getting caught up in all the fuss and all the bullshit that everyone's buying in regional Queensland and WA, because you end up losing your shirt when the market turns the next couple of years. But we're now honing in on Sydney, Melbourne, and plucking off the low-hanging fruit in regional VIC and regional New South Wales. And depending where you're at, this is not a growth play asset. This is a long-term cash flow hold asset. This is something I'll give to my kids one day, right? So I don't care if it's not going to get immediate growth in terms of the market growth in the next 5-10 years, because I've already bought it well under market. I can go and get this easily valued for probably close to 1.34 million and strip out equity. Having it tied into a trust, though, they don't allow you to do that. So this is just a set and forget cash flow play. Low maintenance. All it needs is carpet. I managed to walk 3 of them. I didn't get into one. The tenant didn't allow us in, but she'd be right, mate. They all need carpet. Probably 2 of them need a bit of a paint, and the kitchens. At some stage, may rip out kitchens and replace, but there's no urgency on this. These kitchens are fine. They'll last another 30, 40, 100 years. In terms of pushing rents, supply and demand. If there's no other options for 1 and 2-bedroom apartments, affordable housing, if they've got no other options and you're only pushing up to the market, then they'll pay. And you don't necessarily need to spend the money on a new kitchen and bathroom. I like to freshen up though. I do like to paint, rip up carpet, put hard floating floors down, make it resilient, get a handyman in to grout silicon around the tub just to put life into it. These old school bathrooms, they're not going anywhere. I would never rip this out. They don't build them like they used to. Cast iron tubs. You can maybe, upgrade some of the fixtures and fittings and rip out a vanity, but I wouldn't ever rip out this bathroom. The old school retro bathrooms, they'll come back. It's just like fashion. These old school bathrooms might come back in. I don't. I think they're great. They look great. They're resilient and solid as. Uh, just keep them. But kitchens could, because to rip out a bathroom, you're looking at 25, 30 grand minimum. And you're not going to really get much more uplift in the rent anyway. But you can spend, say, a couple of grand on a vanity, a new mirror, regrout, silicon, paint, maybe replace a toilet, but don't go stripping out all the tiles just to put the nice new shiny, latest and greatest tiles, because in fucking 5, 10 years, those tiles today will be outdated, and who knows? The crazies might think that this fashion might come back. Everyone's dressing like the crazies these days, so this style might do the whole comeback. It's funny. I've got a Nissan Navara, right? The boxy old school 2010 Navara. The boxy shape is now coming back. So yeah, you hold on to it long enough, eventually it'll become fashionable again. So don't worry about stripping out bathrooms, but kitchens, you can strip out kitchens for 8 to 10 grand, but I wouldn't even bother. These are fine. You can paint cupboards, replace handles. It's really all cosmetic. So unless if it's completely shot and needs to be replaced, then do it like these old school ones. But there's always a market for affordable housing. So everyone's on a different level. So you might have a couple in the block that are brand spanking new good, but it's always good to have a good mix, because there's always an elderly man or woman or single person that just trying to get by and doesn't need the latest and greatest and can't afford that. So you can tailor your block of flats to the whole market, where you'll always rent it. Doesn't matter if it's dated, you don't necessarily need to strip it out to push high rent. So it's food for thought. It's up to you. I tend to just fix everything up, clean it up, paint it up, change handles, rip out these old, replace these cooktops, maybe a splashback, but not overcapitalize, because you could save that capital for a deposit for another property in a market that will keep growing, and just refurbish. Anyway, hopefully that all helps with your plans of what you're thinking of doing. But as always, this is by no means financial advice or general advice. This is my story of what I'm doing. Follow along, and prior to making any investment decision, be sure to get third-party, independent financial, legal, tax advice. Until next time, thanks for watching.